And thanks so much for joining us for the Intelligent Investor Select Value Share Fund webinar. I'm Tom Wilson. I'm the investor educator at InvestSmart, and I'm joined by the portfolio manager, Nathan Bell, and also one of the analysts, Nick Cummings. So we're very lucky to have them both here. And we'll get started in just a second. We've already got heaps of questions. And basically how it works is you can actually type in questions as we go. We'll do our very best to answer them. We may not get through them all. But we'll definitely show them on screen, some of the ones we're doing. And this is part of the secondary offer that's now open. So you can actually apply through the Intelligent Investor website and get units issued to you, even get sent straight to your share trading account. And that it closes on the 20th of Feb. I'll quickly just also say that it's general product advice only, not any type of personal financial advice. But enough from me. Thanks so much for joining us, Nathan and Nick.
Thanks, Tom. Welcome, Nick, and welcome, everyone. Sorry for the late start. As always, shows that we're much better investors than we are IT people. First of all, I just want to say thank you to everyone that supported the fund when we launched a year ago, both internally at Intelligent Investor and InvestSmart, and also the investors. Obviously, it's been a fantastic start. It really couldn't have gone any better for us. And even though it's early days, the justification of the way that we structured the fund has borne out. And what I'm actually most happy about is that we haven't made all our returns just from a handful of tech stocks. That's by far and away the most pleasing thing, because what it means is there's still an enormous amount of value in the portfolio compared to the major indexes. So that's really pleasing. But I also hope that through the monthly and quarterly letters, and also through the articles that Nick's mostly written in our publication business, that people now aren't afraid at least, of investing overseas, because all we've really been trying to do is buy more of what we're looking for in Australia, but just in much higher quality businesses, and trying to get them cheaper, because there's more of them overseas. They don't trade at the enormous premiums that they do in Australia. So that's really been borne out. And I really hope through the articles and those letters that people are feeling a lot more confident about investing abroad. Again, we're going to talk about it, but, we haven't been investing in places like China, and where there's a lot of fear at the moment and just the returns have been awful. We're really just trying to stick to our knitting that we've had for now 25 years at Intelligent Investor. Nothing has really changed. We're still trying to find quality and value, intelligent managers, and we're really not trying to complicate our investing. My experience has always been when things get complicated, that's when money usually gets lost and the returns aren't very good. So it is early days, but the performance has been great. And I'm just really happy that as an investment team that we've delivered for everyone that has supported us over the last year. And now I hope there's a lot more people that, whether they invest in our fund or this fund, or whether they're investing their own money or in other funds, that are just feeling a lot more comfortable about the types of quality businesses that there are overseas, and that you don't need to go to far-flung countries or anything like that. You can really just hit the big indexes, the big markets and exchanges in America, and actually get that real global exposure. And it's worked really well so far. But what we're actually most excited about is that we still think the portfolio is very cheap. There's just been this extraordinary focus on just a handful of stocks. And so it's left all these other wonderful businesses trading at extremely good prices. And even some of them have had really big upswings over the last year or so, even the last 6 months. But they'll push so far down in the previous years during COVID and after COVID that they've still got very long runways ahead. And we're going to talk about at least 4 of them very shortly. So I'll try and get through the slides quickly, even though I say that every webinar and I never do. And hopefully that will leave lots of time for Q&A. It sounds like we've got plenty. And with an international fund, there's always more questions than with the Australian ones. So I'll whip through some of this stuff. I'm going to skip straight past some of the slides. As always, we'll send you a copy of the slide deck so you can look at them in your own time. And there's a whole bunch of slides from our previous presentations that I sort of let linger in the background that we won't discuss in the webinar, but you can go back and look at them. A couple of the share price and things in there might be slightly out of date, but it keeps us honest, and it actually takes you through a lot of the stocks that we talked about 12 months ago that we still own, because that's really the huge advantage that an international fund has over an Australian one, is that the turnover should be really low, because we're buying these great companies that can grow for decades, unlike in Australia where they run out of growth pretty quickly, and then you have to look for the next stock idea. And so, if you see a lot of turnover in the fund, then hopefully it's because other stocks have got extremely cheap, but really there shouldn't be a lot of turnover. And so you can go back to those slides and see the half a dozen stocks we were talking about last year. And and see how they've gone. And obviously the answer is everything's gone well. So we've been in a great market, but it's great to have a great start, but we need to keep the momentum going, and we're very comfortable we can do that. So if we can skip ahead, Tom.
Sure.
We might have to go through, keep going. So I thought, we'll talk about performance in a moment, but the thing that I want to recap, particularly for people who are new to the fund and didn't invest straight up and wanted to see how we went, I just want to recap some of the key tenets of the fund and why we set it up that way. And this is really how we want to be measured over time. Obviously, performance is what we have to have, but I always consider that in funds management as something you absolutely have to have. It's a non-negotiable. There's not many industries where you have to excel just to meet people's minimum, hurdle for success. But funds management is one of those. But these ideas are the ones that are going to drive the performance over the long term. And really, we just wanted to look for stocks that we understood, that weren't complicated, but were cheaper than what we could find in Australia. So we didn't want to complicate anything. It's hard enough tracking down these stocks and going through them. We wanted to hold a portfolio of around 30 to 35 stocks. Most of them were international ones, and they weren't just US. They didn't just have US businesses, but they had global businesses. But we wanted to be able to buy them on the US exchanges. It's just much harder to buy other stocks on other exchanges, and the highest quality businesses generally list in America. So the fact you can get global exposure from being on the most liquid, biggest markets in the world makes our job and the rest of the business's job much easier. The other part of the portfolio was dedicated to our best small cap or mid cap ideas in Australia, and that's actually one source of potential value because they really haven't done much yet. It's sort of frustrating on one hand, but it's great on the other hand because all that value is still sitting in the portfolio. And we've got the same thing in our Australian funds. The funds have been doing okay recently, but we've just got all these what we think are wonderful ideas, and yet the market's just so focused on the big cap end of the market, and you're just starting to see now with some of the share price moves in some of these smaller stocks that very, very slowly the market's getting its confidence back, and there's a heap of value in those stocks. But we're going to focus on some of the international stocks today because we talk about the Australian stocks in a lot of other places. Next one, Tom.
Next one again.
Yep. Just go back one. There's just one point I want to reiterate, and we don't have any exposure to Asia other than the small exposure that some of our global stocks like a Visa or MasterCard have in those places. And it really is, it's like if you look at China's stock market, the returns have been terrible for I think nearly 15 or 20 years now, which is just a real reminder that you can't look at economic growth or anything like these macro factors and think that you're going to make money on the stock market. You've really got to focus on the fundamentals of the individual businesses, and I just can't stress that enough. But China actually, if you look at the price to earnings ratios or whatever your favorite valuation measure is in China, for example, the things look really cheap, but I just don't feel comfortable investing in those places. And I want sleepless nights. I said this last time. I want sleepful nights. I don't want to be waking up 2 a.m. worried about when a CEO is going to be pulled out of a company in the morning or has disappeared or the government's decided to pick one winner over the other. Like that's the absolute thing we want to avoid. And again, it was this idea that we wanted to get our members and investors used to investing in these businesses overseas because we don't think it's higher risk. We actually think it's lower risk in a lot of circumstances. And the last thing that we wanted to do was start taking to far-flung places where the normal Western capital rules don't apply. So even though China's cheap, for example, you won't see us putting money there. It's just too hard. And we've seen people like Platinum Asset Management who have invested there for decades just not struggle and not to make money there. And if they can't make money there, then I don't see why we need to be adding that stress when our returns are just fine without going to those places. Next one, Tom. So this is the performance. I wish we could have actually had this up till last night because we've had another great February. I think we're 3.5% ahead again in February. So it's just been performance-wise, it's just been terrific. It really couldn't have worked out any better. But the thing I'd say is, first of all, our returns haven't come from just technology stocks. And if we actually made a mistake so far, it wasn't actually weighting them higher. But one of the key selling points when we launched the fund in the way we did was that we said we can afford to have a more diversified portfolio than we typically have with our Australian funds because we don't think it's going to impact the long-term returns because we're just going to find so many other ideas. And our best stock returns actually haven't come from the tech stocks. They've come from a little small cap company who does business in Brazil, a medical education provider, which we followed for many years. I think it's up about 70%. We've had KKR, which is sort of trying to turn itself into a little bit of a Berkshire Hathaway, and I think it's up 60%. And there's a whole bunch of stocks that are up 50%. And yes, it does include the tech stocks, but they're actually a pretty small part of the portfolio. And it's been a really broad, I guess, sort of renaissance after the period we had in 22 and 23, where the market dropped a bit and was sort of off tech stocks. And now everyone's sort of back on AI, but slowly it's spreading to other stocks as well. And that's actually what I'm happiest about, because if we just had a fund that had done really well just because of the tech stocks, and we had a whole heap of them, then that would be great. But I wouldn't be excited about what the future returns are going to be. And you'll see why we're excited when we go through a couple of stock ideas in a minute.
I'll just add there too that none of the returns, or practically none of the returns, have come from currency. And we've had a cash position that's been 10 to 20% since the inception of the fund, which makes the returns look even better.
Yeah, so we've had a really conservatively run portfolio, and I'm sure there'll be a question about the hedging, and we can answer that. And said we were unhedged for most of the year, and then a couple of months ago, when the Aussie dollar started falling and got a bit further away than the sort of about 10% that I have in mind for putting the hedging on from the long-term average, which is in the low 70s against the US dollar. That's really the only hedge we're ever going to put on. And we've got that on at the moment, but it does run out soon. And it hasn't really done anything. Maybe it was tiny, maybe 0.5% or something like that. It might have added. But I think people don't realize that when you actually put hedges on the currency, it actually costs the fund money. It's not free. Obviously, it's a lot cheaper than it used to be. But nonetheless, you don't want to detract from your returns by over hedging as well. So we're expecting that to roll off at the moment, and I don't think we're probably going to put that on, depending on where the Aussie dollar is. But as long as we're in with sort of the 10% of that long-term mark, then I don't want to waste investors' money putting on the hedges. But if there's a chance where we get a long way from that long-term average, and if the Aussie dollar got down to 55 cents or whatever, then I absolutely want that hedging on, because we want the stocks to be driving the performance of the fund over time. And even though most people have consternation about what the currencies can do, the fact is the global exposure of the fund means it's not just an Aussie dollar, US dollar thing. You're actually getting global currency exposure. But also the most important point, and I can't say this enough or stress this enough, is that the longer you're an investor in the fund, the less the currency matters. If you have to pull your money out at there was one time there many years ago where Aussie interest rates were much higher than anywhere else. And I remember, I think the Aussie dollar might have even got to like $1.10 or $1.17 or something against the US dollar. It was a really unique period. And so if you're an international investor, you were just getting torched if you were unhedged. But as it always happens, is it eventually came back down. So it looked painful on paper, but there was actually nothing wrong with your fund. And you got all that money back. But I remember all the calls at the time was there was all of a sudden the people at the investment banks just falling over themselves to offer the highest forecast. It was like Aussie dollar going to $1.50. And I think it was only like a month after that, it was back to like 75 cents or something. So if you're a short-term investor, yes, the currency matters, but we don't want short-term investors. We want people who are in this for the next 5, 10, 20 years, because that's the sort of businesses we're buying, and that's the process we use. And over 10, 15, 20 years, even 5 years, like the currency is just not going to matter. And if we get some wins on the currency, that's great. If we get some losses along the way, it doesn't really matter either. We just really need to be focused on buying the right businesses. Next one, Tom. So I'll quickly run through these. Obviously, our strike rate at the moment has been almost perfect. Like really, everything has worked. There's only a couple of stocks that were just tiny, absolutely tiny parts of the portfolio that we just wanted in there to watch. We've turned over a couple of those, but some of those have actually gone up 40%. So, we did far better and far quicker in some of those names than we could have hoped. I think the differentiated returns is really important. The Australian index really hasn't done much for a long time, over a decade, and it's because it's mostly just a bunch of A-REITs, some banks, and the iron ore miners. And the banks haven't produced capital gains now in sort of 10 or 20 years, depending on which one you're looking at. The A-REITs have been very similar for the most part, other than sort of a few great names like Goodman Group. So it's really tough for the index to do higher returns in the future compared to the past, when it was, I remember, I think it was about 2014, I did the returns on Commonwealth Bank was like 14.5% annualized with these huge growing dividends. So I think the future growth of the ASX is not what it's going to it's not going to measure up to what it used to be. But I know people are still holding all those what used to be great stocks like the Commonwealth banks, and they're probably sitting on huge capital gains and they don't want to turn them over. So I really do understand that. But this is a fund for maybe you can take the dividends from those stocks you've got as large positions in your portfolio and drip them into a fund like this, where we think we're going to get much more growth in businesses that are sort of like buying Commonwealth Bank, I guess, in the early 90s, where you still had lots of capital growth and dividend growth in front of you. And even though you don't get the franking credits from these overseas businesses, the dividends do add up over time. I think if you read Warren Buffett's most recent letter, he talked about, I think the dividend yield on his American Express stock that he's famous for buying decades ago is something like 75% now. Now you can't have it both ways. You've either got to have the capital gains or you measure the dividends. But it just shows you even those great growth companies can really grow dividends quite quickly when you own them for long enough. Next one, Tom. So I think I've really talked about all these already, so we'll skip along and we'll start getting into the stocks. I've made this point before, but the world's major indexes look stretched to us on valuation grounds. And so at some point, you never know when, but like a rubber band, they'll snap back. But our stocks are much cheaper. And what we really tried to do when we launched the fund was we tried to provide a bunch of examples where we were buying rivals or virtually the same sort of business overseas for a fraction of the price that we were paying for the same businesses in Australia. And some of those I've just listed there. It's Ferguson versus Reece. They've actually had the same share price performance since we launched, but Ferguson is still much, much cheaper than Reece, and Reece looks extraordinarily expensive for the growth, in my view. Rightmove versus REA Group. REA Group at the moment is starting to do its best impression of a Nifty 50 stock from the 70s, for those that can remember. It really is trading at astronomical valuation now. And All Funds, which is one we've bought recently, it's sort of a similar version of Net Wealth and Hub, which have been darlings of the ASX for a while, which unfortunately we missed in our Aussie funds. So again, it just reminds you that we're just trying to keep things very simple and we're just trying to get more value for our dollar. Next one, Tom. So our largest position is Fairfax Financial still. I think it's still at an early point of investors rediscovering what was great or what is great about this business. I'll talk about that in a minute. We've had absolutely minimal turnover. It's really just been adding a few stocks rather than taking anything away. There's a couple of small stocks, as I said, that we let go of, but we've potentially increased the returns of the fund while decreasing the risk. And we even threw an Aussie stock in there, Mineral Resources, which in our view is trading at half what it's worth. And it's phenomenal. Everyone's so focused on lithium at the moment, they're actually forgetting that that's actually not where the most value is in the business. And I think its mining business is probably worth the current share price alone. So basically getting everything else for free. So that's really what we wanted. We wanted an international fund with a handful of the best Australian stocks we can find, and Mineral Resources is certainly that, and it's a big position in our other Aussie funds as well. And I already talked about that last point about, even though we're going international, and yes, there's a lot of macro stuff going on, and people are worried about interest rates and inflation and all that sort of stuff, but it really doesn't matter. If you invest with our process, you're looking and analysing individual businesses, and you've seen how big the stock price moves have been. You never know when you launch a fund. 12 months ago, you just sort of, you were buying a lot of value and you never know how it's going to go. You don't know how much support you're going to get. We could be sitting here in 12 months and the market's gone down, and we'd be apologising for our poor performance and trying to tell everybody about all the values in the funds. And as it turned out, the market in the last few months has just taken off. And fortunately, we were well prepared for that in great stocks, and we've got the benefit from that. So you can't time markets. Don't get put off by the macro stuff. The great businesses persist. The great businesses keep increasing margins, keep increasing revenue, and the underlying performance of our individual business has been just terrific. And a few of them we're about to talk about right now are absolutely killing it, and I don't think that's fully reflected anywhere near in their valuations. Next one, Tom. So I'm just going to race through my two stocks and then hand over to Nick, who can go into a bit more detail with a couple of other stocks, which are a bit more interesting we haven't spoken about before. So Fairfax Financial was our biggest holding in the fund from the start. The stock has performed very well. I think it's up like 40, 50%. Actually received a short report last week, which we thought was pretty much garbage, given it wasn't the quality of the work that was the issue, because Muddy Waters have a very big reputation for their shorting. But it just seemed like a quick money grab, because even with the issues they highlighted and They weren't the bigger picture. They were just minor things. And even they were only talking about book value being overstated by about 18%, which really has nothing to do with the cash coming out of the business or the fact that they've got interest rate hedges in for the next 3 years. And so this business is trading on, after the short report, it was actually trading on 5 times earnings and book value, with ROE actually about now forecast to be 17%. When you ask, okay, why is it trading so cheaply? It's because people think interest rates are going to go back down, and therefore take the business's earnings with that. But there's actually a bigger story with this business. And Prem Watson, who was always talked about as Canada's Warren Buffett, he actually put on some hedges. I think it was about in the mid 2000 teens. And his idea was he was worried about valuations in the market. He thought interest rates would go up, and he was going to clean up again like he had in the past by getting the macro calls right. And turned out the bull market persisted and sort of embarrassed him, I guess. And people got fed up with the stock, and they've just left it behind. And the share price has recovered a great deal from them, but I still don't think it's anywhere near reflected the value in the business. And there's a whole lot of optionality in this business, just like there always has been with Berkshire Hathaway, because of all their different investments. It's exceptionally well run. And I'm absolutely comfortable with it still being the largest holding in the fund. Next one, Tom. So the next one's a good story because we've followed this business for a long time, and it really got carted out during COVID, because essentially this is a medical student education provider, and once no one could go into the classroom, it basically stopped this business overnight. And it's been a very fast-growing business. There's a government program that has put these revenues into the private sector, and there's a doctor shortage across the country, particularly in regional areas, and they're trying to educate as many GPs as they can, and AFIA is one of the prime beneficiaries of that. But it got absolutely killed in COVID, and then when the market fell in 2022 because of the fear around higher interest rates and all the rest of it, inflation and whatnot, the share price got absolutely slammed because the earnings growth wasn't there. The business was also investing very heavily, and it really did push the balance sheet to the limit. But now what you've got is a stock that the earnings has rushed back. I think it's 40% earnings growth in the last year, and now it only trades at a PER of 13, and the business is absolutely flying. So this is a sort of business that normally you would expect, given current multiples for these sort of businesses, would be trading at something like 30 times, not 13 times. And now you've got all this leverage that's sort of doubled up because of the leverage on the balance sheet, but also the operating leverage where the margins are increasing rapidly because the bottom line's growing so much faster than the top line. And the top line's growing pretty quickly too. And they've recently just signed up another whole bunch of new seats to train a whole bunch more doctors. So this, again, is a typical business for an intelligent investor. It's off the radar. It was cheap. It was under a lot of pressure. Everyone's saying emerging markets are uninvestable, and here was a business that we thought was cheap, well run, management with a lot of skin in the game, and it actually has a major shareholder from America who I assume at some stage will buy us out. I don't exactly know why they haven't bought us out already, and if there's a stipulation in there, I think that may have prevented them from acquiring the company 100%, but they have been sneaking up the share register even further. So it seems inevitable that they're going to buy it at some point. But I'm pretty sure that given the CEO in there at the moment, who's been there for a long time, the founder, he'll make sure they pay a pretty penny for it. So this is what we're excited about. Is I think you've got to be really careful just thinking a stock's going up and then all of a sudden it's expensive. I think that's one of the biggest mistake I made early in my life as an investor. And it's one, if you're new to investing, it's the easiest mistake in the world to make. But this stock looks really cheap to us and could easily double again and still look cheap. So this is why we're excited about the fund, not because we've got great returns so far, but because of what's to come. So with that,
I just wanted to say, Nathan, I was just going to quickly say that we're getting a lot of comments and questions, and it's fantastic. And this one from RP, to me, it sums up exactly the purpose of the webinars that we hold, but also with the research and recommendations that you all put onto the Intelligent Investor website. Like, I find myself going down a rabbit hole and reading all about the different stories, the businesses, who runs them. And I just wanted to put that up there while we had the chance.
Yeah,
so.
I'm glad to get that feedback, because the thing is, Nick and I, we've been investing overseas for a long time. I think I bought my first stock in 2007. So it sort of looks easy in a way. Oh yeah, you just go and find these businesses. But this is really the benefit of, particularly two people, but a whole team effort of, 17 years of experience on mine, and, a long, maybe not quite as many with Nick, because unfortunately for him, he's a younger man. But, to do this on your own is really hard work. Like you're just chasing down these stocks, and even overseas, like there is a limit. It's sort of like you go down a rabbit hole because there's thousands of stocks, and it's like you're just looking at them all the time. But this fund is really the benefit of all of our experience over many years. You can't just sort of pick this up and go and find all these stocks. And we've followed AFIA for I think 5 years, 6 years now. So it's a lot of work, it's a lot of late nights, but we love this stuff. But at the same time, this is what you pay us for. The fact that you're getting it for free in the subscription business is a bonus for everyone. But this is why you pay the fees. You expect us to outperform because we have this experience. But at the same time, we're happy to put ourselves under the pressure to deliver because we have the experience and we love this. And it's interesting. It's I'm 48 years old now. I started at Intelligent Investor in 2006, and 18 months later, like I just wanted to be the best analyst that I possibly could. And to me, I sort of wish, looking back, I just wanted to be rich like Warren Buffett, and I probably would have done better. But I just wanted to cover so many stocks. I just wanted to know every industry and what makes a good business and what makes a bad one. And the benefit of that nearly 20 years later is that all these stocks from around the world, and we just didn't have a way at Intelligent Investor to share all these ideas. And it's been quite frustrating because the Aussie market gets really expensive really quickly. And you run out of stocks. It's just not that there's probably only 20 or 25 great businesses in Australia, whereas I think there's 100 stocks in the US that are called the dividend aristocrats that have increased their dividend by is it 10% a year or something for 50 years or whatever that crazy statistic is. And there's just no way to share these ideas and get them in front of people. So, and I think finally, people are getting to the point now where they're more open about international investing than they've ever been before. And there's a lot of reasons for those trends. It's cheaper to buy overseas stocks on exchanges now. It's easier. And people use the products from a lot of these companies. Like everyone knows who Google is and Apple and all these things. Like the world is just a much smaller place than it used to be. So I'm really glad we got the fund away when we did because, obviously we'd still be excited if we launched today, but it's really nice to get some runs on the board early. Nick, so how are we going to deliver going forward, mate?
Thanks, Nate.
No pressure.
Next slide, please, Tom.
Yep, sure. Sorry, I was...
No, that's all right.
He was looking at the pictures thinking I wouldn't mind one.
Yeah.
I was actually. Yeah.
So Diageo as a business, I've been following for the best part of a decade. It's always screened as a high quality business, but it's always looked too expensive until recently. So Diageo is the world's largest manufacturer of spirits. It owns household brands like Johnnie Walker, Scotch, Gordon's Gin, Smirnoff Vodka, and it's got market leadership across those categories. And protecting those market leadership positions are really high barriers to entry. So the first one is the aging process. So if you look at Scotch needs to be aged for 3 years, has to be aged in Scotland. And that just represents a huge barrier to entry for an upstart competitor who has to fund that working capital for 3 years. They actually have to do also more than that. So if you've got a successful brand after 3 years, you need to have put the cask in after year 1, after year 2. So you've got a product to sell in years 4, 5, and 6. And for the incumbents like Diageo, it represents a massive advantage. So they've got a 40% market share now in Scotch, and as that category grows, that market share increases. And that's the aging process also is a big factor in certain gins, certain tequilas, and rums as well. Another barrier to entry here is heritage. Many of Diageo's brands are well over 100 years old, and that allows them to really create a luxury factor and charge a premium price. These brands are really appealing to the affluent consumers, and they've been shifting the portfolio over the last decade towards those more luxury brands. And that heritage aspect is just really, it's impossible for an upstart competitor to recreate. And the other good thing about Diageo is the category's growing. So you probably read headlines that alcohol sales and volumes are flat. In spirits, at least at the price point, they're not. So spirits are growing. They're taking share of beer and wine. And Diageo, again, as the world's largest manufacturer and with those barriers to entry, is really benefiting from this. And we think that'll continue.
I remember early in my career, if you talked about international investing with anyone, and I'm talking like going way back to the sort of mid-2000s, like 2006 and 7, when I started getting interested, everyone always talked about Diageo. It was like the Woolworths of international investing, because it was just an easy business to understand, and it was growing at double digits, and just had everything a value investor could want in a business. Huge margins, big. It was your classic Buffett stock. And it's interesting to see the cycles that various industries go through over time. So we've got, at the moment, it's the AI theme, and real momentum. Like, the market's just at the moment favouring anything that's rapidly growing revenue, as long as it's profitable. And that's all it's really looking at. And that's really being pushed by the index funds, who aren't paying any attention to valuation whatsoever. And these businesses were really hard to buy at a cheap price, because everyone knew how good they were. And then in the teens, in the 2000 teens, Warren Buffett got together with a company called 3G, which are a bunch of Brazilians, like private equity guys, who some people might remember. And because it was always in the paper, this was getting written about all the time. And Charlie Munger actually said it was a mistake for Buffett to get involved with these guys. But their premise was they made a lot of money in the beer industry. And so they were really, they went and made some big acquisitions in the US with some fast moving consumer goods businesses, which, this sort of business is. It's these, sort of pretty quick turnover, very high return businesses, very predictable, sort of mid sort of growth, but it was very predictable, and you had these huge returns on equity. And so the valuations of these sort of stocks just went through the roof, because and their plan really was just to cut costs. That was really all it was. There was nothing more complicated than that. And Munger thought it was a mistake, because Munger thought it was reputable damage to Buffett, because it really was just sacking people, which Buffett and sort of Munger weren't really renowned for. But anyway, it just shows you the cycles, how they come and go. And now there's a few, red flags around this industry about changes in alcohol preferences and whatever. And now finally, after all these years, you're finally able to buy one of these great businesses at a reasonable price. But now most people in the market don't care, because it doesn't do anything with AI.
Yeah, that's exactly right. I mean, it's fallen to 17 times earnings, down from 25 or 30 times. So it's the cheapest it's been in the last decade. And as you said, it is a resilient industry, and there's still 5 to 7% revenue growth on offer here. At the moment, the stock price has fallen because sales are normalised after the pandemic. That's really a short-term issue. And I think Diageo is a really good example of the advantage we have when we invest globally. We can sit back and be patient and wait for these opportunities to come to us, rather than, if this was a high-quality stock on the ASX, it might have fallen 10 or 15%, but then it's just picked up by fund managers that have got the fear of missing out of that next run. And if you're paying those higher valuations, you're going to guarantee lower returns in the future. And so we can be really choosy with this portfolio. And Diageo, again, an example I've followed of a company I've followed for probably a decade, and it's always looked really, really good, but too expensive. And we got our opportunity a month or so ago. So yeah, that was good.
We'll come back to this in 5 years, and we'll see who's done better, Diageo or Woolworths.
Yeah, exactly. Yeah. Well, hopefully Diageo. I'll put my money with Diageo. Can I have the next slide, please, Tom?
Yeah, sure.
So Allfunds, this is a bit of a different business. Allfunds is the world's largest investment platform, so it's very similar to Netwealth or Hub. Essentially, the best way to think about them is they are the middleman. They connect the advisors to the fund managers. And the secret sauce with them is they've negotiated a common set of protocols with fund managers over 2 decades that determine who pays the fees, when they're paid, how the data is shared, and importantly, who's responsible for compliance, which is really important in their main market, which is Europe. And the beauty for the advisors is they get access on Allfunds' platform to over 1,000 fund managers with the click of a button. And rather than going on a one-by-one basis, they can invest straight away. So they would have to, if they didn't go on Allfunds' platform, they would have to go to each fund manager individually and negotiate those protocols with them. So it's just a huge burden for them, and Allfunds simplifies that and takes a lot of cost out of their business. On the other side, the beauty for the fund managers is Allfunds has a ton of assets because they have the advisors on the platform. So it creates a real network effect, or a flywheel, where the more distributors that come on, the more funds that want to be on there, and then it's really a virtuous cycle. The industry is also benefiting from a similar thing that's happening here in Australia, where the regulators are changing that in-house model. They really want to divide or split up the advice and investment management businesses. And as an independent platform, all the funds has been the beneficiary, but still they've only got about 25% of the assets in Europe have moved over to independent platforms. So there's still a long runway for them to pick up more assets. We got the opportunity. The opportunity sort of arose after their IPO in 2021. It IPO'd at the top of the market, and then as the market crashed or market fell, it got hammered, and so we got the opportunity to buy it at under six euro per share, and that was down from 18 euro per share just after IPO. But importantly, we don't think the business's intrinsic value or worth has fallen by 70%. This is, again, we think a short-term issue, and as the markets have returned, when the markets do start to grow again, assets should return. And we're getting this business now for, again, around 17 times earnings. Hub and net wealth trade at 50 times or above, and we're getting mid-teens type growth. And management recognise how cheap the stock is. So the stock's really, business is presided over by a founder owner, Juan Alcaraz, and they're exploring strategic options at the moment. Whether that's a sale or not, it's hard to say, but last year they did have, someone did bid for the company, and that was at 40% higher than the current share price, and they knocked that back straight away. So yeah, Allfunds is just another example of the opportunity set within the portfolio at the moment, and I honestly couldn't be more excited. I know, sort of rehashing some of the stuff Nath said, but the opportunities that we've got at the moment, even though we've had strong returns, is unbelievable. Like I was saying to Nath the other day that even though some of those stocks are up 40 and 50%, they could have decades or years ahead of them of further gains. And so yeah, I'm incredibly excited as I was at the start.
Yeah, it's unfortunate we don't have a time machine to go and buy Hub and Net Wealth at the start again, but this is sort of a smaller but second opportunity at least. I think that's all we've got from the official slides. The one point I just always make with our funds, because they are listed on the ASX, I think a lot of people confuse when there's not a lot of trading in the stocks as though the funds are illiquid. The actual trading in the stock itself has nothing to do with liquidity of the funds, and you're not going to find many more liquid funds than this. I can't even imagine what the average market cap is because of the bias with the US tech stocks, which one of them is $3 trillion now, so it's enormous. So don't mistake those things. It's an extremely liquid portfolio. I think it's a very safe portfolio. This was designed to be a fund that no one should be stressed out about owning. That's really what it's about. And hopefully now that you've got a bit of insight into the individual companies, and hopefully you've been following us for a year through this journey, and you're feeling a lot more confident about our experience, about what we can deliver. And I think, but I always get the confidence just from going into the individual stocks. I always find if I ever start to feel a little bit of stress from the market or some macro something or other or whatever it is, maybe an unhappy investor or member, is I just go and look at the actual presentations from the companies themselves, and just instantly I feel relaxed because I just look at these businesses. I wake up every day and I look at all four of our portfolios of Intelligent Investor, and I just have, even when they're not performing well, I just have no stress whatsoever. I just look at those group of businesses and the people running them. I just think over time, how can we lose? And it's just that the price you just have to pay for owning a select bunch of stocks like that is short-term underperformance, and obviously that's not an issue here. But we're not always going to be winning, but it's great to be off to a great start. And again, thanks to everyone that supported us so far. So with that, we've got time for Q&A. It sounds like there's lots of questions, but if we do run out and there's 2 minutes, Nick, you could jump into KKR, because I just think it's an interesting story. But we have talked about that in some of the copy leading up to this webinar, so we might not have time.
Did you want me to quickly just do some admin and knock off some questions? I was just going to say that this is part of the secondary offer, which is, I guess, one of the reasons why we do it. And, there's always questions like, why do we actually do secondary offers? What I'll do is I'll just show the page so that everyone's on the same page. So we have the secondary offers for a number of different reasons. Obviously, the biggest reason is getting the fund back out to a lot of people who, might have forgotten about it or not seen it. It's pushing it to the forefront of people's minds. But when you're applying through the website and you're actually applying for units in this particular ETF, you're not going through the broker. You're actually going directly through us, and we issue units to you. So you're not paying brokerage, and you're not paying that spread, the difference between the buy and sell price. If you've got a HIN, a holder identification number, that's what your share broker unique account is. That's fantastic. You click apply, you type that in, and we'll send the units directly to that share brokerage account. So that's one of the easiest ways. So SMSF, no worries. Your name, joint share brokerage accounts, not a problem. But if you're someone, and this is the other reason why we do these offers throughout the year, if you're someone who doesn't use a share broker or doesn't like using a share broker, what we do is we issue units and we send it to the share registry in your name or the entity's name. And then in the future, if you wanted to sell them, it's up to you to transfer them to the share broker of your choosing. So that's one of the reasons, the rationales behind doing it. You can see here that the information's all on this page, and I'll put up the actual place to go just so as you have an idea. And very important information, because on the right-hand side, you can see that it closes on Friday, the 23rd of Feb, which means that you need to have your funds to us by 5 p.m. on that day. So if you are going to apply, try and send the funds as fast as you can so that, BPay gets to us in time. And then we list it on the 1st of February, and we actually get the price from the closing net asset value, and that is taken from the 23rd. So when it closes 5 p.m. on the 23rd, we take that price and issue you those units. There's a lot of other information. The fees, obviously, product disclosure statement, very important to read. If you ever get stuck, at the bottom right-hand side, you can actually ask our team questions, and that's manned Monday to Friday, 9 a.m. to 5 p.m. A lot of information here. What I'll do, though, is I'll just go back and we can keep going with the questions. There's heaps of questions.
For those unfamiliar with Intelligent Investor too, if there's new people, it's also the easiest way for us to grow our business. And we do need to grow it. We do need to get bigger and more profitable and keep reinvesting in the business. And we also want to make sure that we hang on to our investment talent, because that's our biggest asset, is the people in our investment team and across the business. So we need to be, wages are going up all over the place, and we need to be able to hang on to people. And so to me, this is the most efficient way to support our business. And the most honest way, because we're getting in front of everyone. And if we're doing poorly, we front up at the exact same time every year. So we'd be doing these webinars anyway. So the fact that we take the secondary offer on is sort of, secondary in the sense that, we want to be getting in front of you. We want to be showing you the value in the portfolios. We want to explain ourselves if we're not performing well. We want to give you the reasons to hang on or to put more money in, all those sort of things. And you should never be afraid of your investors. So you will always see us, once a year for each of the funds, or every 13 weeks. And even if you're invested in one fund but not another one, sometimes it's just worth jumping in anyway, and you'll see our latest thoughts on whatever's happening in the markets or particular stocks, because I actually try to have the funds as similar as I can, because people say, oh, you've written the same report for the growth and income fund. Well, yes, because ideally the perfect stock would be for every portfolio. It would be a stock with a huge dividend yield that was growing at 20% a year, and it passed the ESG filters. So it'd just be 3 funds that are exactly the same. So that's really how I start with a stock, trying to put it in the portfolios. Is you're looking for that sort of perfect stock that ticks all the boxes and it's going to work out well. But obviously each fund has its own biases. But in terms of stocks that are in the news from one month to the next, if they're just the same stocks, then I'm not going to write a separate report. It's just get them out there. And obviously everyone doesn't read all the reports for all the different funds. So hence why you see it's not a mistake sometimes when you see a very similar report, even if it's got different holdings and different performance numbers.
There's a little question there just from Pradeep talking about distributions, planning for year ends, fully frank. Did you want to talk a little bit about the income that the fund generates?
Yeah, look, like this isn't a dividend fund. If dividends are what's most important to you, then our income fund is the one for that. The next, you don't have to wait for the secondary offer, obviously, but the next webinar and secondary offer for that is in August. So we didn't do one of those too long ago for that fund. In terms of distributions for all our funds, basically do semi-annual distributions. And there are two parts of the distribution. There's just the underlying dividends from the stocks that we have to pay out. Now, obviously, this is essentially a growth fund, so dividends aren't the main reason, although over time those rapidly growing dividends really do add up. But again, this is not a yield fund, if you like. And what was I going to say? And the franking is obviously going to be very low. Even the Australian stocks that we put in this fund don't tend to be big dividend payers, so it's not going to be much franking at all. So if fully franked dividends are what you want, it's the income portfolio. This is very much a growth portfolio, and Australia is really the only place in the world that has franking.
Great.
The one other point was sometimes you do see these really big distributions from our funds, and that's because if we crystallize capital gains from big sales, which we had at the end of 21, we had some really big takeovers for our two largest positions in the Australian funds that we had at the time. It was Sydney Airport and a small telco stock. And so like the way the funds are launched and the restrictions of the ASX and all the rest of it, we have to pay out those capital gains as distributions. So when you'll see in those years these massive capital gains distributions, which is sort of frustrating from a business point of view because you've made all this money and then you just have to give it back. You really want to be reinvesting that and getting the future returns on top of that. That's how compounding works. But that's what you'll see in the past, where you've seen those mighty ones as opposed to sort of more regular dividend yields.
Excellent. There was a question here too. Just a bit of housekeeping, I guess. With the full list of the companies that are inside the fund, we actually give all that information to the ASX. So if you go to the ASX website, look up this particular fund and the others, go to announcements and look at portfolio update, you'll see the current holdings of the fund there. This is an interesting question too, is why is the benchmark index, the ASX 200, would a global benchmark not be better for comparison purposes?
Yeah. So this was a really big point in the launch of the fund. And the only two choices really were the ASX, the major ASX index, or the major US one. The MSCI is a poor performing index. And because we've got a performance fee on this fund, we wanted to set the hurdle as high as possible. We called this the no BS benchmark. It has a high watermark as well. So go out in the market and you'll find all sorts of silly indexes that make sure there's big, massive performance fees, and we didn't want that. So we picked the highest returning market through history, and that's been the ASX 200. So we want to set the bar as high as possible. But also the way I think about it is that the ASX index is really the hurdle for putting your money overseas. So if you can't do better than that, investing abroad, then you should just invest in Australia. So they were the two reasons.
Excellent. And another question, a bit long, but talking about how RPM and FDV are already in the IIGF, why put them in IISV? But also, there's about 35 companies. Are we going to keep it around there? Or it might also tie into that 10 to 20% of cash we've got in there. And I know that you're not someone, you or Nick aren't going to pull the trigger randomly and just get stocks for the sake of it. Did you want to cover those 2 points at once as well?
Yeah. So the real one of the key things with the launch of the fund that I talked about a lot was, if you look at the best funds across the market, it's always the fund managers that merge the best of local and overseas. And you'll actually find there's funds that they call their Australia funds that are actually full of overseas stocks. And I won't name all those funds. It's not that they're doing anything wrong, but they are their best performing funds. So we want to replicate that. And it makes sense, because the more flexibility you've got, the higher your return should be. So the reason, Frontier is a tiny position in the fund, but it's probably the only stock that I know that has the potential to go up tenfold from here. And so what we wanted to be 70 or 80% invested in international stocks, and the other 20 or 30% came from our best ideas in Australia, and they were mostly going to be our small and mid caps, because we didn't want to miss out on them, because they are cheap at the moment, like potentially very, very cheap. And so we didn't want our investors missing out on them. So it is a global fund with the best of Australia, but it is mostly global. You should think about it that way, but that's why you see RPM, Frontier, Mineral Resources now, and I think MAF's in there, MA Financial, which I think is one of the best small mid-cap stocks on the ASX. So we wanted these companies that we can hold for the next 20 years. These aren't just small caps that we think are like discount to value, by 30% or whatever. Once they go back to value, we're going to sell them. We really wanted to own these businesses for the next 20 years, and there aren't many of those on the ASX, but we wanted to make room for them. In terms of the maximum holdings, we're actually only allowed to have 35 holdings. So there'll be no more than 35, and we've actually had to sell a couple of minute holdings to make room for other ones. We want the turnover to be low. The cash at the moment is about 10%, but it actually was lower than that at one point. It's just because we sold a couple of things recently. So, normally we're going to be mostly fully invested all the time. The minimum time holding most stocks, that's a good question. So really this is a question on turnover, and the turnover for this fund should be even lower than it is for our Aussie funds, which is low as well. So, I don't know what it's going to be on average. It's a bit hard to say because market sometimes you get real busy and then other times you do absolutely zero. And we really haven't done much in the Aussie funds for the last 2 years. But I would have thought, we wouldn't be turning over the fund more than 20% of the fund in a year. So certainly we're going to be considered a low turnover fund. That was one of the key selling points when we launched the fund. I think the words I said was buy right, buy once. That's really what we're aiming to do. We don't want to turn the portfolio over. Because we're trying to buy the best companies in the world, essentially, we shouldn't have to turn over the fund. Just get out of the way, get out of our own ways. It's like the biggest mistake I've made over time is just underestimating how valuable the great and unique businesses are. And it's hard because you're still a value investor at heart and you see the valuations these businesses get on. But, as any great investor will tell you, it's almost always a mistake to sell the great businesses. The ASX listing doesn't create the ASX listing doesn't create any disadvantages. In fact, it's the reason why you're actually seeing a lot of Australian fund managers now switching from the old LICs to these actively listed ETFs. And the reason they're doing that is because their LICs are trading at huge discounts to net asset value, and then some of them are getting taken over and they're losing their funds under management. So everyone's actually moving in our direction. So it's more the advantages of the way we've set them up. And it was lucky timing. I mean, if we were doing this 10 years ago, we probably would have done LICs as well, but the world's changed and now you've got these listed ETFs and people are much more familiar with them. They don't trade at discounts or premiums, and that's a really good thing for investors, and they're highly liquid, unlike many LICs, which are highly illiquid. So they actually solve a lot of problems from the LIC world that many Australian investors are used to. In terms of what's the advantage of buying our fund over any other overseas listed fund, look, if you don't think we can outperform, then don't give us money. I always say that. I'll back us in because we've been doing this for 25 years and we haven't let anyone down yet, and certainly don't intend to start now. Yes, our returns are lumpy, but you can't have great returns for 3 or 4 years without having 1 or 2 down years. That's the price you have to pay. And yes, some people are doing better than others depending on when you invested in the fund. But the longer you own one of our funds, then the more likely you are to outperform, because we've been doing it, as I said, for 25 years. We've got the best team, I think, now than we've ever had. It's the most cohesive, the most supportive. It's got the most worldwide experience. And it's just fantastic to be a part of. And our business, like the whole InvestSmart Intelligent Investor business, has come so far in the last 5 years. It's really exciting to be a part of the business. We should have had some of these funds many, many years ago before we finally had them, but different people want to do different things. And I think we had 10 CEOs in 10 years at Intelligent Investor. We could write a book on some of that stuff. But this has been quite incredible. But it's really, it's just great to see the smiles on everyone's faces. Now we're really making some progress with the business. But in terms of the funds themselves and the performance, all you should care about is, can we safely outperform the market? And if that's what you're looking for, which I guess is what everybody's looking for, then you back us. But you have to go through the bad with the good. There's just no escaping that. But in terms of any difference, I think probably the other big difference is that we're a small fund. So we can move very quickly and get in and out of things that, there's interestingly, all funds that Nick just talked about is one of the biggest holdings in one of Platinum's asset management funds. I think it's like 3.5%. So we've actually got, pretty small portfolio holdings compared to our Aussie funds, which are a bit more concentrated because they've got less stocks to choose from. But that hasn't held the fund back. But actually it still is an advantage to be, like the international fund at the moment, I think it's got $30 million in it. Now, you've seen what's happened at Magellan, who chased every dollar that they could and got to $100 billion, which becomes impossible to outperform with. And you've also seen with Platinum, who have stuck to their knitting, and they've still got all the respect from investors for doing that. But they have so many great ideas, but they become like 0.5% or 1% of their funds. So even when they, really hit the nail on the head and get, a triple from a stock, it just doesn't make any difference to the funds because they're running $26 billion and we don't have that problem. So I'd say they're the two big advantages we have.
There's a couple other questions here I'll just try and knock over. We have the net asset value, which is calculated at the end of the trading day, and that's actually put onto the every one of our funds has an actual area where we list it for every single trading day, but we also have an indicative, an INAV, net asset value, where we calculate it throughout the day, and that's on the actual page for each of the funds. A couple of questions, obviously, always we get about the offer itself. Apart from brokerage, is there any other reason to buy directly through the offer? Yeah, you don't pay spread. So you don't pay the difference between the buy and the sell price. We give you the net asset value directly in the middle. Plus, some people, like I mentioned, don't have share brokerage accounts. You can just have it sent straight to the share registry if you don't want to use that. Let's have a look. There's heaps of other questions here.
I'll just say also, in addition to, sorry, Tom, in addition to that former question about what makes us different, again, like if you're not picking on Platinum here, I'm just using it as a well-known example, but when you're running a fund with billions of dollars in it, like there's no way in the world you can buy MA Financial, RPM Global or Frontier or any of these things. And if you just get one of these stocks right and they become 10 baggers over the next 5-10 years, like that makes an extraordinary difference to your performance of your fund. And there's just no way in the world they can buy those stocks. And you can tell the funds that all bought Afterpay because they're the ones that are cycling really poor performance now, but they had this incredible performance and no one was really admitting how much they had in that one stock. But you can see from their returns that they must have had 10 or 15% or more maybe in that one stock. And when one stock like that goes up tenfold, or depending on when you bought it, might have gone up even more, like that one stock can drive your outperformance for 5 or 6 years. So that's an advantage we have. And that's why I really wanted us to have the flexibility of buying some of those best small caps.
There's a lot of questions here. We're running out of time too, because we've gotten to the
I'm happy to go and sorry, Tom, I'm happy to go another 5 or 10 minutes if we can.
Yeah,
got
sure.
A lot of questions.
There's a question here talking about the InvestSmart professionally managed accounts, which are diversified, although they offer diversification, but they're passive. We talk a lot about having a core and satellite approach where on the satellites there are actively managed investments, and from within the InvestSmart PMA, you can actually add all 4 of the intelligent investor ETFs. So obviously we can't say you should do this as a strategy, but it is entirely possible based on your own circumstances.
Yeah, and I think that's perfectly sensible too. Like some people just don't want to have all their money in active funds and they don't want to suffer the wild swings in performance at times. They just want something far more stable. Like volatility isn't risk for us, and it's really hard to explain to someone who's probably new to investing. But you can be doing everything right in a fund, and yet your returns can look awful just because the market just doesn't happen to like your stocks at the time. But that's a really sensible way of managing a large portfolio, is to have a nice core of ETFs and then particular, whether it's a theme or a type of fund or a type of style, and just overlay that at the top. That just gives you a great diversification and hopefully gives you a little bit more of a bounce in the good years, and it lessens the magnitude of any falls in the bad years. It's perfectly sensible.
And there's a question there too. It's something that we get asked in the portfolio services team about if we will ever get any of the these ETFs rated. I know you answered this for us all the time, Nathan. Did you want to answer it in the webinar?
Yeah, no, look, we'd love to, but it's just impossible for a lot of different reasons. Our business is structured very different to a typical fund. Like Nick and I, or all of us on the call, for example, we're all staff members. We don't own we aren't the big equity holders. We're not the founders. Normally the funds that get rated, at least at the start, generally 2 or 3 people have broken away from their existing jobs. They formed the fund's business themselves. They own all the equity, and they generally have a bunch of investors that are willing to invest in the fund straight away to support them, to get the fund up to the sort of amount where everyone can survive and pay their costs. And because the whole point of the ratings is that everybody wants to, cross their backside to make sure no one gets in trouble. So if you're really small, if you don't have big contracts with the key staff members that are going to make them wealthy, if you don't have a big pipeline of investors to invest in the fund, like from the get-go, then for all those reasons, you're just never going to get rated. And because our funds business comes essentially off the back of what we've done in the subscription business over the past 25 years, we just don't have that set up. And, we don't have the investors lined up. We don't have the investment staff on big contracts, and, we own some shares in InvestSmart, but they would want to see all these things tidied up, and we're just not at the size where we could do any of those things anyway. So unfortunately, we can't get rated, which again is why these webinars are really important to us, because we need our investors to support us to grow the business, because if we can't do it through these webinars, then we don't really have another easy way. It's really hard to find independent financial planners that want to take money out of somewhere else that's potentially doing well and give it to us. We always have been a retail business where, the money is sticky, and that's great, but there is a limit to how much money people can give you, and they're already invested in other funds. So it could be quite hard. Say, a good example is probably this fund, where people can see the performance and they go, that's great, but they've probably been with Platinum for 20 years, or maybe they've still got money with Magellan, or I know Hyperion, or whoever else runs an international fund, and they don't want to take the money out of those funds because it crystallizes big capital gains. So we're always, in a sense, competing for the marginal dollar, because if you want to raise a lot of funds under management as a business, it's a game of market share. You're not really getting new money from a new investor. You're having to get money from someone to take it from somewhere else. So that's another reason why these webinars are really important to us. And I'm glad we've delivered on the performance, and hopefully this this webinar does really well, and we raise a lot of money, and we've got a lot of happy people in the years to come. But unfortunately, we just won't be able to get rated.
No worries. There, of course, is a lot more questions, but we might just try and wrap up so that we can move on to the end. But what we might even do is, eventually list some of the questions. I'm going to upload this webinar to the website, and even where you have started to watch it from, it'll be on YouTube. It'll also be on that events page, but we'll put together an actual video for you. And there's a lot more questions we received actually offline. So I'll go through that and try and put them together for us as well. But, you're always welcome to get in touch with us. I'll just see if I can get the actual, there's a lot more slides. We'll put the slides.
So I was just saying, I'm really surprised that the limit on net wealth, for example, is so low for such a high quality diversified fund. Like, I would have thought, that would be perfectly fine for an individual stock, but even for something like BHP, that's like 13% of the index, to have only 5% maximum. Like, I understand, we are listed ETFs and all that type of stuff, but that really doesn't pass the pub test. But unfortunately, there's nothing we can do about it, which is frustrating, because obviously want as many dollars as people are willing to support us. So that's frustrating to hear.
Excellent. Well, did you want to add anything, Nick, before we go?
No, just how incredibly excited I am about the future of the fund. Like, we started 10 months ago and it's gone great, but we've still got a great opportunity set in front of us. And regardless of the index, we think this fund can perform well over time. So hopefully we get a fair bit of support, and thanks for joining.
Yeah, if anyone has questions, and maybe they're a bit afraid to put them on here, or they're a bit more specific, or whatever, it's a stock, question about a stock or whatever, by all means, send it in to us and we'll be more than happy to answer. But I also just, again, I've said it a couple of times already, but I just want to thank everyone from within the business and all our supporters, whether it's members or investors that have put money in the fund, or have been, we still hear from people who have been with us for basically day dot. It's 25 years now we've been in the business, and we're going stronger than ever, and it's really pleasing. We've come a long way, particularly in the last 5 years, I think, and we couldn't do that without the people that support us, and the investors, and the people that genuinely have a long-term view and support us through the tough times, which is what really matters most to us. So thanks again to everyone, particularly those who supported this offer and who supported us from launching this fund last year. It's been terrific, and thank you.
Lovely. Well, thank you all so much for joining us, and we'll see you next time.
And thank you, Tom.
Yeah, thanks, Tom.
Anytime. Thanks, guys. Bye.
Thanks, mate. Bye.